Have you ever wondered which investment strategy can make you the most money in the stock market? Should you bet on the companies growing rapidly, or those that seem like hidden gems waiting to be discovered? Today, we'll dive into the two most popular strategies, growth investing and value investing. By the end of this video, you'll have a clear understanding of both approaches and how they can fit into your investment portfolio. So, let's get started and uncover the secrets of these two powerful investment strategies. When it comes to investing in stocks, two fundamental approaches stand out: growth investing and value investing. These styles are like two sides of the same coin, each with its unique characteristics and benefits. Let's explore these strategies in detail to understand how they can help you achieve your financial goals. Growth investing. Growth investing focuses on companies that are expected to grow at an above-average rate compared to other companies. Growth investors look for businesses that have shown strong earnings growth in the past and are expected to continue on this trajectory. Key characteristics of growth stocks: higher priced than the broader market. Growth stocks often have high price-to-earnings (PE) ratios. Investors are willing to pay a premium for these stocks because they believe the companies will continue to grow and generate profits. High earnings growth records. Growth companies typically have a consistent track record of strong earnings growth, often outperforming average market gains. Even when the economy slows down, these companies may still perform well due to their innovative products, strong management, and competitive edge. This resilience makes them attractive to investors seeking higher returns. However, it's important to note that past performance is not always indicative of future results, and careful analysis is required to identify sustainable growth opportunities. More volatile than the broader market. Growth stocks can be more volatile. If a company misses earnings expectations or there is negative news, the stock price can drop significantly. Growth stocks represent companies that have demonstrated better than average gains in earnings in recent years and are expected to continue delivering high levels of profit growth. However, there are no guarantees. Emerging growth companies are those that have the potential to achieve high earnings growth but have not yet established a history of strong earnings growth. Examples of growth stocks: technology companies. Many technology companies, particularly those involved in cloud computing, artificial intelligence, and social media, are classic examples of growth stocks. These companies often show rapid revenue and earnings growth due to their innovative products and services. The tech sector's constant evolution and its pivotal role in modern life make it a fertile ground for growth investing. However, the fast-paced nature of tech also means higher volatility, requiring investors to stay vigilant about market trends and company performance. Healthcare innovations. Companies developing cutting-edge medical treatments or technology are also considered growth stocks due to their potential for high earnings growth. Innovations in healthcare, such as new pharmaceuticals, advanced medical devices, and biotechnology breakthroughs, can drive significant revenue increases. These companies often benefit from ongoing research and development, regulatory approvals, and growing demand for improved healthcare solutions. However, the sector's dependency on regulatory outcomes and market acceptance can add an element of risk. Value investing. Value investing, on the other hand, is all about finding undervalued stocks that the market has overlooked. Value investors seek out companies that are trading for less than their intrinsic value. They believe these stocks will eventually be recognized by the market, leading to price appreciation. Key characteristics of value stocks: lower priced than the broader market. Value stocks often have lower PE ratios compared to growth stocks. The idea is that these stocks are undervalued and will bounce back once the market realizes their true worth. Priced below similar companies in industry. Many value stocks are created due to investors overreacting to recent company problems, such as disappointing earnings, negative publicity, or legal issues. These stocks are often trading below their industry peers. Less risky than growth stocks. While they carry some risk, value stocks are generally considered less risky than growth stocks. However, they can be more suitable for long-term investors as they may take time to turn around. Value fund managers look for companies that have fallen out of favor but still have good fundamentals. The value group may also include stocks of new companies that have yet to be recognized by investors. Examples of value stocks: consumer goods companies. Companies that produce everyday items people need, like food and household products, often fall into the value category. Financial institutions, banks and insurance companies, especially those that are well established but facing temporary challenges, can be good value investments. Growth or value, or both. The debate between growth and value investing has been ongoing for years. Each strategy has its proponents, and both can be effective depending on market conditions and individual financial goals. Which strategy is better? Growth stocks. These stocks have the potential to perform better when interest rates are falling and company earnings are rising. However, they may also be the first to decline when the economy slows down. Value stocks. These stocks, often from cyclical industries, may perform well early in an economic recovery, but can lag during a sustained bull market. Combining growth and value. Many investors choose to combine growth and value stocks in their portfolios. This diversified approach aims to balance the potential for high returns with reduced risk. By holding both types of stocks, investors can gain throughout different economic cycles, smoothing out returns over time. Historical performance. Some studies show that value investing has outperformed growth investing over extended periods on a value-adjusted basis. Value investors argue that a short-term focus can often push stock prices to low levels, creating great buying opportunities for value investors. Making the choice. When deciding between growth and value investing, it's important to consider your investment goals, risk tolerance, and time horizon. Short-term focus. If you're looking for quick gains and are willing to take on more risk, growth stocks might be more suitable. Long-term focus. If you prefer a more conservative approach and are willing to wait for your investments to appreciate, value stocks could be a better fit. Practical tips for investors. Do your research. Whether you choose growth or value stocks, thorough research is essential. Look at a company's financial health, management team, competitive position, and future prospects. Diversify your portfolio. Don't put all your eggs in one basket. Diversifying across different sectors and investment styles can help manage risk. Stay informed. Keep up with market trends and economic indicators. This will help you make informed decisions about when to buy or sell. Be patient. Both growth and value investing require patience. Markets can be volatile, and it's important to stay the course and not make impulsive decisions based on short-term fluctuations. In the world of stock investing, both growth and value strategies offer unique opportunities and challenges. By understanding the key characteristics of each approach, you can make informed decisions that align with your financial goals. Whether you choose growth, value, or a combination of both, the key to successful investing lies in thorough research, diversification, and patience. If you found this video informative, then don't forget to hit that like button and subscribe to our channel for more amazing content. Thanks for watching, and until next time, happy investing.